if you just receive your December bonus or you simply have some cash in hand and you're thinking to yourself, how do I start investing? This is the video for you. Please give me 20 minutes of your time to convince you on why you need to invest to leave the rat race. And second, how do you actually start investing? And what are some concrete steps that you can take to eventually reach your financial goals? As someone who has invested for more than 8 years, this is my financial framework to get you to the 6 or 7 figure portfolio that you want. So to understand why you must invest to leave the rat race, right? There are two things that you need to understand. So the first is actually inflation. So inflation is the gradual loss of purchasing power due to the gradual rise in prices for goods and services over time. So in simple terms, it means your MIPO will keep rising in price and the money that you put inside the bank, right, will keep dropping like grape like that. You keep complaining, right? Last time MIPO only $2, $3, now it's like $4, $5. So that is inflation lah. So Singapore's inflation rate, right, over the last 20 years was around 2%. That means, regardless of how you feel, your money will lose 2% of its value per year. So the next item that you must understand is compound interest and how time is your best friend when investing and compounding your wealth. So Albert Einstein, smart guy, right, can listen, So he once said that compound interest is actually the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So please take a moment to start comprehending it. So if you do not start investing, it is you at your old age who will pay for your mistakes in the early years. So what exactly is compound interest, right? The official term is here, but then in simple terms, compound interest is simply the interest calculated based on your initial capital and also on your accumulated interest. So in Chinese terms, they call it 利滚利 or interest on interest. So the easiest way is to use this example. So for example, you put $10,000 into an investment that yields you 10%. So for the first year, you will get back your $10,000 plus the $1,000 in interest, right? So now you have 11,000. But for the second year, you will earn interest of 10% based on both your $10,000 and your interest, which was $1,000. So in total, you will get back $12,100. Why? Because you'll get interest based on your initial capital of 10,000 and also that 10% on that first year of interest, which is $1,000, and 10% of $1,000 is actually $100. So that is why you will now have $2,100 extra compared for your initial investment and your second year investment. So for the example, right, after 25 years, you actually have 108,000. So that's actually 98,000 worth of interest compared to your initial capital of $10,000. So in investing, time is actually your best friend. So the earlier you start investing, the better it is. So if you decide to actually add just $1,000 per month for the next 25 years, right, you will actually have $1 million that you have always wanted. In fact, you will only need 23 years to hit that 1 million. Now that you understand why you must invest, next is what I would do to start investing. And I call it the 5 steps to investing. So step 1, building the base layer. So what do I mean by building the base layer?
I am building the first layer of my financial journey.
So first, if you have any credit card debt or any debt that is above 5%, please do not start investing. So credit card debts are usually at 20%. So even if you get a very good return of 10% per year, you just simply cannot out-invest a bad debt. So it's like a sinking ship, right? Water is coming in at 20%, 20%, 20% per month, and then you are trying to scoop out 10% per month, 10% per month, 10% per month. Eventually, you will swing like Sevastopol like that. So you simply cannot out-invest a bad debt. So next is the emergency layer, which usually you can consist of around 3 to 6 months of your pay, so that in the case that you lose your job, right, you have some buffer there, and then you can sleep peacefully at night while still giving yourself some time to find the next job. So third, do not play with current money that you need for future money that you do not need. So for Singaporeans, right, this can be your one-time known big expenses such as renovation or your wedding. So the stock market, right, is not a place for you to randomly tapa your $10,000 in and then you start to flip to 20,000, flip. Oh, my wife says she wants the fresh flowers for the wedding, please. But please, jokes aside, okay, please no, okay, don't treat the stock market like a gambling den, okay, that's the fastest way to failure. In fact, right, I would say that majority of people fail in investing because they always start out on the wrong step. So why do I say that, right? I'll explain a bit more later. Because if you think about it logically, right, you already know that there's upcoming expenses, but you still decide to put that $10,000 that you need into the stock market. So that is effectively the same as buying $10,000 worth of lotto and toto tickets and praying that you will strike. It is the same thing. So now that you have cleared your debts, right, and also set aside money for emergency fund, and also for your known big expenses, the next step is to understand what are T-bills, Singapore saving bonds, and high-yield saving accounts. So I think for high-yield saving accounts, I think probably you all know about it, and I shall not cover it a lot here. And I think Saif has a great article on them, so I'll put the link down in the description box below. So next is actually T-bills and Singapore saving bonds, and this is the layer that I would call the wealth preservations. They will roughly give you an interest around the rate of inflation, which they will not help you grow your wealth, but it is a layer that lets you sleep at night, knowing that if you have some spare cash and that inflation is not eating away at your purchasing power. And for you gamers out there, right, it is like a PUBG bandage. So it's like you are standing in blue zone and then your HP drops by 2% per click, right? And then the T-bill and SSB is just like you tying a bandage and then preventing you from dying, recovering you back 2% of your health per year. So T-bills and SSBs are considered very safe instruments. You are providing loans to the government for their projects like infrastructure, and the government pays you 1 to 2% for that loan. So T-bills are usually for shorter term for half a year or 1 year, and then SSBs are for longer term at 10 years. So generally, right, you can actually combine step 1 and step 2 together, such that you can keep your emergency funds or your money that you have set aside for a reno or wedding inside these high-yield savings account, T-bill, or SSBs. So anyway, if you're interested in SSBs, right, you can check out ilovessb.com. This is not a joke or a scam. The website sounds funny, I know, but then whoever maintaining this site, a very big thank you to you, as it has really very good information of the current SSBs and the upcoming SSB as well. So it even includes a projection for the upcoming SSBs, and you can do your comparisons and then decide whether you want to buy them or not. So next, we move on to the most critical layer, which is the middle layer or step 3, which should be the core of your investments and the layer that really compounds your wealth. So this is the layer that's actually the easiest yet the hardest. So this is the layer that teaches you that investment does not need to be complicated, but needs to be consistent. So this is the layer where you learn about paying yourself first, which is the term where you allocate monthly a sum that must be invested. So you ignore what happens into the market and your dollar cost average to the fund every single month that you will think will do well and go up in the long term. So before we jump into some things that you can actually buy, right? So we need to first understand what is pay yourself first and what is dollar cost average. So what exactly is pay yourself first, right? So in simple terms, right, it means that every single month when you receive that green statement in your bank account, right, you will transfer a predetermined amount out of your bank such that you forget about that sum and you cannot and will not touch this amount of money. So rather than saving and investing what is left, right, you deliberately transfer out the money once you receive it, and you can only spend what is left of your pay. So it is a complete 180 from the usual way of saving, whereby you only save or invest what is left, which is a lie because there's usually nothing left. So the next term that you must understand is dollar cost averaging. So in simple terms, right, dollar cost averaging means setting aside a particular sum of money, maybe $200 or $500, and simply buying the shit out of the market every single month regardless of what the market is doing. So for example, if I set aside $500 every month, if the price is at $10, I will buy 50 shares. If the price is at $25, I will buy 20 shares, and if the price is at $5, I will buy 100 shares. So for this 3-month example, you can see that I have used up $1,500 to accumulate around 170 shares at an average price of 8.83. So with the average price of 8.83, you can see that while we are not able to buy the absolute bottom, we achieve a better average than if I bought at $10 or $25. So dollar cost averaging is actually about removing emotions and removing timing from the equation. So I mean, if everybody was able to time the market and to buy low and sell high, you may as well tell me what total number is going to open next week. So now that we have learned what is pay yourself first and what is DCA, how do we combine both of this knowledge together? So firstly, every time you receive your pay, right, just transfer that dedicated sum of money out from your bank into the broker, such as Longbridge, Tiger, Mumu, or whichever broker that you want to use. And of course, if you want to support the channel, I'll keep the links down below so that you can start your investment journey. And the next step is just to set up your automated investments, or what they call regular saving plans. And majority of the brokers do provide automated investments or regular saving plans. So you can follow the instructions of all the major brokers and set up your automatic investments. So actually, once you have set up these automated investment, right, actually you're done. The amount of shares will keep growing month by month, and it will form a bigger and bigger portfolio. Eventually, compounding takes over and you snowball your portfolio into a much bigger monster. And this is why I say this is the easiest yet the hardest to do, because it requires rewiring of your brain, such that you pay yourself first and that you have to set aside current money for future growth. It is about sacrificing today for a better future tomorrow. So the easiest part comes after you have decided to change your habit and thinking and let compounding take over. So now that you understand what is pay yourself first and DCA, The next step, obviously, you ask me is, what to buy, right? So this is a beginner-friendly ETF list that should be enough for you to kickstart your investment journey. So if you think the US market will do well, you can invest in the S&P 500 through tickers such as VOO and IVV, the SPY, and CXPX. So, and if you think US tech will do well, the QQQ or QQQM will be great for you to start. So QQQ actually has more liquidity, but QQQM has a lower expense ratio. So it is probably better for you long term as a small retail investor. So what is expense ratio, right? So expense ratio simply is the annual amount of fee that you have to pay to the fund manager. So the lower, the better. So, and if you like to support local, to support the SG market, right? So ES3, it tracks the STI ETF, which generally consists of our big banks, such as DBS, OCBC, and UOB, or household names that you would have heard of, like Singtel, ST Engineering, SGX, and many others that even your akong would know. And if you like Hong Kong stocks, right, like Alibaba, Tencent, Meituan, HSD, or Hang Seng Tech, that is listed in Singapore will be good for you. And if you like REITs, those who like to be 包租公one, so support your Vivocity, Heartland Malls, CapitaLand. So the Lion Philip S REIT, CLR, would be good for you. So instead of going there just to shop, right, at least the shops are now paying you some rent through dividends. If you simply want to bet that the whole world will improve and do well together, Vera, a very famous one, or Isaac, will work well for you to start your investment journey. So now that you know how to clear your debt and where to put your emergency funds and know how to pay yourself first and DCA, next we move on to step 4, which is buying of individual stocks. So this is the layer that you really must do intense research because you are now picking individual companies to invest in and you will be a shareholder of that company. So effectively it's like finding a husband or wife, right? You want to know how well she's doing, what kind of job he has, or does he have any debt. You don't want to 随便 swipe on Tinder and like, 这个长得不错嘞，这个蛮帅的，这个蛮美的嘞。
I got a match on Tinder! Yay!
So you wouldn't want to go to a broker app and this symbol 不会派嘞，哇 cake 不错不错 and just buy, right? So generally I think many of the first time investors fail because they always start with this layer. So they always invest in companies that they heard from someone or maybe from Reddit, Wall Street Bets. So in this run, right, like BMNR, SBET, or in the previous run like AMC, GameStop, and they always buy stocks that the apes tell you to buy. Ape to get too strong. Then it proceeds to drop 90% and then they say all is a scam. But if you think about it, right, who go and click that buy button? So it is you, right? You are the degen, right? Who followed that Wall Street guru? So this is the layer that will really test your conviction. So what material are your balls made of? So what kind of research did you do so that your boss can tahan 70 or 90% drop and then continue to keep buying? So without research, right, you'll be like a 青青草原 sheep, getting to be slaughtered. So you will never be able to find an alpha over the market and to beat the S&P 500 or even the market in general. So if you are not researching or reading up on your stock for at least 30 minutes a day, right, I would strongly suggest you just buy ETF, DCA and don't care about the market. It will probably give you sanity in the long run and it will probably keep you much more convicted in the investing game. And this is the layer that you have to know where is your advantage. So if you're working in the semiconductor industry, right, you keep OT and then have a lot of projects and then you are super busy, you should probably buy some semiconductor stocks. So if you work in Adobe or any of the software related companies and you think that, wow, 有点太闲空了, you are too free, you probably should sell all of your stocks in software companies. And then if you work with Excel sheets and find them a bit stupid and cumbersome, have you seen cloud functions that help you create pivot tables and do whatever coding that you want? So perhaps buying some Anthropic shares when the IPO will work. Or maybe what do LLMs need? So maybe inference training, or data centers. Or if you ever wondered why your SSD or the SD cards that you put in your camera is so expensive, right? Just look at SanDisk or Western Digital stocks and you will know why it is so expensive. So you have to understand, right? This layer is the fastest to accumulate and boost your wealth, but it's also the riskiest and you have to do a lot of intense reading and research on the individual stocks that you buy. And this is exactly why I do not suggest people who have just started investing to buy individual stocks of a company. But I know lah, you are Singaporeans, right? Your hand itchy, hand always very itchy, hand very itchy one. Go and buy a bit first. Or if you have built up a lot of conviction on one stock and you have done a lot of research, you can also apply what you learned just now in step 3, which is dollar cost average, and you can just keep buying the shit out of the stock, so you do not feel as pain, right, when the individual stocks just crash like 50% and you can just keep on buying, keep on buying, keep on buying. In fact, in my own investment journey, it was also DCA that helped me stay sane through the drop of Palantir. So Palantir actually dropped from 14 all the way to 6 before climbing all the way back up. So at the end of the day, right, please do not start with step 4. You need to build up some knowledge of investment and what to buy first. And I would say, right, the reason why most of beginner investors fail is because they always start with this layer, which I find very weird. If you're starting out at step 4, right, without anything, you are a degen as well. So it's like playing slots as a casino, right? You walk. Wait, 这个 machine 有 feel.
I knew this was the one.
Oh my gosh, we actually won!
Let's go. You put in the $100 and you pray, right? You pray. Got bonus happen, bonus, dung. But it didn't happen. It shows you the screen, right? You know the 50 cents, the full degen screen. You have 50 cents left. Do you want to gamble or not? So please, this is investing, not gambling. If you want to choose your company, you have to choose it wisely after researching. So lastly, step 5. For all you degens out there, I know you are there. So this is the layer I would call the moonshot pot, where you ape together strong. So this layer, right, should not be more than 5 or 10% of your pot. So this is the layer where you bet on the next technology or like the next big thing that you want to gamble or test a bit on. So these are things that have not been proven yet, like cryptocurrency or simply stocks that have big potential but research level is not there yet. So for me, right, some stocks would be like in the quantum computing space or the nuclear stocks, which you probably have heard of them for like 10 years, but the progress seems very, very slow. Or even cryptocurrency, you know, people have been talking about it since my uni days for 10 years, like 10 years ago, but the actual usage on the ground level seems to be zero. So anyway, if you want to start investing in crypto, some platforms that I use are actually CoinHako and Crypto.com. So, but please, investing in crypto bears a huge risk, perhaps more than 10 times of like holding ETFs or individual stocks. So please do not start at level 5. You will get yourself wrecked. Okay, so to sum it all up, right, we cover in this video of why you must start investing in 2026 or why you must invest to give yourself a chance to leave the rat race. So we learn about what is inflation and the power of compounding. Next, we also covered my personal framework in investing, which is the 5-step pyramid, where you first build a solid foundation of clearing your debt and building your emergency fund and setting aside money for your known big expenses. In step 2, we learn about T-bills, SSB and high-yield saving account. And in step 3, we learn about the most fundamental layer of your investment portfolio, which is ETF, DCA, and pay yourself first. And in step 4, we learn about how to choose your own company, knowing where your advantages are and why people fail at investing. And finally, in step 5, we learn about the moonpot shots and letting yourself to gamble just a bit on the next big technology. So at the end of this video, this is one unpopular opinion for you. So if you are starting out at zero or have a very, very small portfolio, pay for a big drop in the market. Go and have your net worth cut by 50% or 70%. This may sound stupid, but logically, right? Do you want to hone your skills when your portfolio is small and grow your boss and change the material of your boss when your portfolio is small? Or do you want to have your boss check when your portfolio is at 6 or 7 digits? So you have to understand that it is always easier to average down a portfolio that is $1,000, right? Rather than a portfolio that is $10,000 and even more so a portfolio that is $100,000 or $1 million. So you want to accumulate shares, right, while it is cheap. Keep on buying shares when it is cheap. And then when the market moves up again, that's where your wealth explodes. And then that is where you reap your rewards, right? From your suffering that you've endured for the past few years. So actually, these are the knowledge that I've accumulated so far, and I hope that it was useful to you. And if you think I've earned it, please share with your friend, give it a like, and subscribe to the channel. So at the end of the day, right, you'll probably learn more about investing when you put your own money in instead of hallucinating, will I earn money if I invest? So give yourself a chance to reach your financial goals and start your investment journey by using any of the brokers down below. They are all currently running promotions, so you can use any of them down below. Or if your friends or families have some links that you can use, just use theirs. So stay safe out there, and thank you for watching, and I'll see you on the next video. Bye bye.